It's time for another Repo Madness update. I'm getting really tired of this clown show, but unfortunately, from what it looks like, it's going to get a lot worse before it gets better. Especially with the amount of emergency liquidity that the Fed is putting into the repo market. So today, what came out was the Bank of International Settlements released a report, their quarterly review, for December 2019. And the report is 154 pages, so I don't recommend reading it. I didn't read the whole thing myself. However, if you hit Control F and you just type in repo, there is some very interesting things there from pages 21 to about 24, and including an entire section on repo, September stress in dollar repo markets, passing or structural, by Fernando Avalos, Torsten Ehlers, and Egemen Aaron. Hopefully I was okay with those names. And so they wrote a piece here with some charts and graphs that's only a couple pages. And this talks about they're going through what happened at the beginning of repo when it first became public, late Tuesday night, September 16th. And then the official press releases came out September 17th, and they talk about how things are going up to now. So the mid-September tensions in the US dollar market for repurchase agreements or repos were highly unusual. Repo rates typically fluctuate in an intraday range of only 10 basis points or at most 20 basis points. So 100, for those of you not familiar with what a basis point is, 100 basis points equals 1%. So 10 basis points is not very much, 20 basis points is not very much either. On the 17th of September, the Secured Overnight Funding Rate, SOFR, the new repo market-based US dollar overnight reference rate, more than doubled, and the intraday range jumped to about 700 basis points. So a 700 basis point jump is 7% jump. That's a large move during the market intraday. Intraday volatility in the federal funds rate was also unusually high. The reasons for this dislocation have been extensively debated. Explanations include a due date for U.S. corporate taxes, which I personally do not believe, in my opinion, and a large settlement of U.S. Treasury securities, yet none of these temporary factors can fully explain the exceptional jump in repo rates. The box in the article, they did charts and graphs on the distribution of liquid assets in the U.S. banking system and how it became an underlying structural factor that could have amplified the repo rate reaction. U.S. repo markets currently rely heavily on only 4 banks as marginal lenders. That's according to Wall Street on Parade, which has the list of the primary dealers. They put out an article in November. The article has a lot of traffic. It is: the Fed has created the big lie for Congress on its repo loans, while the New York Fed blocks Freedom of Information requests. So it's a good article. I highly recommend reading the article. And there's a list of primary dealers on there with some of the larger American banks, including Wells Fargo, JP Morgan, Goldman Sachs. Deutsche Bank's even on there as a primary dealer. So they have to buy treasuries. Bank of America Securities is listed on there, and Citigroup, among others. But there's also smaller Wall Street investment banks on there that would not be able to buy a lot of U.S. Treasuries that they might be able to, that they might be forced to buy. So they would have to go and get additional funding, because if you're a primary dealer, if you can't sell those Treasuries, you have to buy them, you're stuck with them. Okay, so back to this report. Okay, as the composition of their liquid assets became more skewed towards U.S. Treasuries, their ability to supply funding at short notice in repo markets was diminished. At the same time, increased demand for funding from leveraged financial institutions, e.g. hedge funds, via Treasury repos appears to have compounded the strains of the temporary factors. Finally, the stress may have been amplified in part by hysteresis, effects brought about by a long period of abundant reserves owing to the Federal Reserve's large-scale asset purchases. A repo transaction is a short-term, usually overnight collateralized loan, although now we're on to 14-day term repos. There's a good amount of those, and in the last couple weeks, there's been a 42-day term repo, and tomorrow, the 28-day term repo kicks in. So we have 2 42-day term repos that have kicked in. The last one kicked in, I think, on December 2nd, the first one at the end of November, and we now have a 28-day term repo that kicks in tomorrow on December 9th. So that will be a lot of additional repos. There are so many repos the term repo. So many of these term repos. So many 14-day term repos, and now the 42-day term repos, and the 28-day term repo that kicks in tomorrow, that Jim Bianco on his Twitter earlier today, about 8 hours ago, just put out a prediction. He is expecting total amount of repos per day to go over $500 billion. Over $500 billion per day. So you add in the overnight repos, and then you add that up with the term repos. Now, some people have been checking that website and hitting the reload button of the New York Fed website, and I've spoken to Jim Bianco on Twitter about this, and he says that the other data that he pulls this from is obviously not on just that one website. So the people there who are going to keep sending me in the comment section that you don't know what you're talking about, I hit the reload button every hour to check the repo and you're wrong. I spoke to Jim Bianco. I will work on getting him on for a podcast. The problem is everyone wants him on for an interview now because of that chart he put out on his Twitter of $300 billion over $300 billion per day already in total repo. When you add overnight with the term repo and the not QE that the Fed is doing, he's adding them all up. So everyone is requesting an interview for him now, but I will try. So he is predicting we go to over $500 billion per day in total repo, overnight and term repos, in 2 weeks or less. And let's put things in perspective here to past financial crises. In past financial crises, there was a big spike in repo prior to the tech bubble wrecking. The repo went up from about $100 billion per month to $300, $400 billion. There's charts of this. The $300 billion per month, $400 billion per month range. So that was a large spike. In 2008 and 2007 and 8, repo spiked a lot from under $100 billion or more per month up to $300 billion or per month or $400 billion per month. So that was a spike of about threefold in a month. We are now at, if Jim Bianco proves to be correct with his prediction and his math, we are going to be more than that per day. So what used to, the repo market used to cause big repo spikes and cause problems, emergency liquidity injections, and cause worrying at the Fed in a month of repo. Now we are almost up to that per day, which is about a 30x higher than 2008 with repo. Emergency liquidity injections. But the overnight repo is not all being added to the Fed's balance sheet. The Fed's balance sheet has not, I did the math, and it was not a full $300 billion increase yet. It's getting close since the end of August. So it's almost up to $300 billion. I think it's like $293 billion increase since the end of August, officially. If the Fed were to be audited, I suspect it would be a lot more than that. But that's why the Fed doesn't want to be audited. That's why the Fed doesn't want transparency. So the last of the repos the last of the new term repos will kick in. The 14-day term repos are not done. There are 14-day term repos. They increase the size of them. They increase the amount of them offered. So all these term repos are being layered on. So anyone who says repos are only overnight, you haven't been paying attention. There's been term repos now for months. There's been 14-day term repos since the first couple weeks that we found out about repo. The Fed announced 14-day term repos, and then you started getting a lot of criticism from towards the Fed from a lot of mainstream financial people with the term repos. Okay, so back to this research. As the composition of their liquid assets became more skewed towards U.S. Treasuries, their ability to supply funding at short notice in repo markets was diminished. Same time, increased demand for funding from leveraged financial institutions, e.g. hedge funds, via Treasury repos, appears to have compounded the strains of the temporary factors. Finally, the stress may have been amplified in part by hysteresis effects brought about by a long period of abundant reserves owing to the Federal Reserve's large-scale asset purchases. A repo transaction, okay, I already talked about this. I already read this because I forgot because I went off on a tangent. And I'll put a link to the tweet from Jim Bianco in the information and description section after the show's over. With a commitment to buy back later at the same price plus interest, repo markets redistribute liquidity between financial institutions, not only banks as is the case with the federal funds market, but also insurance companies, asset managers, money market funds, and other institutional investors. In so doing, they help other financial markets to function smoothly. Thus, any sustained disruption in this market with daily turnover in the U.S. market of about $1 trillion could quickly ripple through the financial system. The freezing up of repo markets in late 2008 was one of the most damaging aspects of the great financial crisis. The other parts I've talked about in 2008 was what was accepted as quote-unquote good collateral in 2008, where for years mortgage-backed securities had been paying out the interest payments on them. There wasn't massive defaults on mortgages up until 2007, 2008. So for years, mortgage-backed securities were perfectly good collateral until they weren't. And they were accepted as good collateral in the repo market. And then very, very quickly, a matter of months, these assets became liabilities. This good collateral became toxic. And I suspect something similar may be happening. I don't think it's mortgage-backed securities. I suspect eventually the Fed will, it probably has to do with collateralized loan obligations because of all the red flags we are seeing with corporate bond markets and leveraged loans and collateralized loan obligations. So there is no proof yet that the Fed is buying CLOs. I suspect probably over the next 6 months or so, when we see more downgrades in these leveraged loans, what's happening first, the CLOs haven't blown up yet. But we are seeing massive downgrades of the leveraged loans that are stuffed, that are chopped up as toxic sausage, derivative sausage, and then stuffed into CLOs. And so these downgrades will happen first, and then there will be defaults on these leveraged loans, and then the CLOs will start to really bleed out. Okay, back to the article. There's a bunch of interesting charts and graphs here on page 21 if you want to take a look. Share of Treasury holdings in fungible liquid assets by size group, net lending through repos and federal funds by size group, reserves and Treasury holdings of banks in the U.S. And quantitative tightening has taken that down quite a bit. Treasuries has gone up, but the amount of reserves, quantitative tightening, balance sheet reduction by the Fed took a lot of reserves out of the system. So the Fed almost, with the quantitative tightening and just small amounts of quarter basis point rate hikes, and yes, they did do a good amount of quarter basis point rate hikes, they didn't even get to 3%, and they almost broke the system. And that's because a lot of these over-indebted large governments and over-indebted corporations, as interest rates went lower in the past, they just kept adding more debt. It was not smart long-term. It was smart for the corporate executives short-term to boost earnings. Long-term, it was stupid to add more debt to the balance sheet. Okay, back to this report. The liquid asset holdings of U.S. banks and their composition have changed significantly since the global financial crisis. Successive rounds of large-scale asset purchases reduced the free float of long-dated U.S. Treasuries available to the market between the end of 2008 and October 2014. On the flip side, banks accumulated large amounts of reserve balances remunerated at the Fed's interest on excess reserves. And Danielle DiMartino Booth and others have said that the large primary dealer banks, the 4 largest banks in the U.S., were earning 20% of their net profits with interest on excess reserves. And we know also from the Real Vision TV interview that they released for free, that was behind a paywall, but they released for free on their YouTube channel, where Danielle DiMartino Booth, a former Dallas Federal Reserve insider, was interviewing another former Dallas Federal Reserve insider, George Goncalves. And I'll put this video in the last 30 seconds. It'll be linked on your screen there at the end of the show, probably 10 minutes after that, if you haven't watched that video. And they're talking about how basically the Fed's going to have to go to a permanent repo facility. They're talking about how it's QE on demand. They agree with a lot of what Jim Bianco is saying. I know Danielle's really good friends with Jim Bianco, how the Fed is drugging the repo market now with just almost unlimited liquidity. But finally, and this was a very interesting tidbit from that interview, George Goncalves said that the Federal Reserve actually, when they were increasing interest on excess reserves, there was a bunch of foreign central banks that were docking cash at the Federal Reserve. So the Federal Reserve and American taxpayer were paying interest to foreign central banks. Cash there, docked at the Fed. A lot of it, apparently. Good job, Fed. I'm being sarcastic, okay? I don't want to see in the comment section that I'm saying nice things about the Fed. I routinely criticize them. All central banks. They're all doing the same stupid stuff. And rules changes. More rules changes coming, unfortunately. Welcome to dystopia. Repo rate started to increase. I forgot where I was on the... because I went off on another rant. Accumulate large amounts of reserve balances, remunerated Fed's interest on excess reserves. After the Federal Reserve started to run down its balance sheet in October 2017, reserves contracted quickly but in an orderly way as intended. Alongside banks' holdings of U.S. Treasuries increased, almost trebling between end of 2013 and the second quarter 2019, as repo rates started to increase above the interest on excess reserves from mid-2018 owing to the large issuance of Treasuries. A remarkable shift took place. The U.S. banking system as a whole, hitherto a net provider of collateral, became a net provider of funds to repo markets. The four largest U.S. banks specifically turned into key players. Their net lending position, reverse repo, assets minus repo liabilities, increased quickly, reaching about $300 billion at the end of June 2019. At the same time, the next largest 25 banks reduced their demand for repo funding, turning the net repo position of the banking sector positive. The big four banks appear to have turned into the marginal lender, possibly as other banks do not have the scale and non-bank cash suppliers, such as money market funds, to hit exposure limits. Concurrent with the growing role of the largest four banks in the repo market, their liquid asset holdings have become increasingly skewed towards U.S. Treasuries. This makes sense because the primary dealers and the four largest U.S. banks are included in that list of primary dealers. They have to buy U.S. Treasuries. So if the U.S. Treasury is issuing an enormous amount of debt, and they are with the massive budget deficits, and both political parties are on board, essentially on board with this, because Republicans are borrow and spend and Democrats are tax and borrow and spend, and neither party really seems that interested in trimming trillion-dollar. It's actually larger than trillion if you count the off-balance sheet stuff, but the officially trillion-dollar budget deficits. So the primary dealers have to buy more and more treasuries, and normally in the past they could resell them to other people. They could sell them to pension funds. They could sell them to insurance companies. They could resell them on the secondary market, or the Fed would buy them back under the table when there was less treasuries issued. But if the Treasury is issuing massive amounts of debt, and the U.S. Treasury from I think June they needed to issue $14 billion minimum from June to the end of this year. So that's a lot of treasuries to issue in a short amount of time. And so it sounds like it overwhelmed the primary dealers, because the primary dealers had to buy whatever foreign governments, foreign central banks, pension funds did not want to buy. And it sounds like a lot of these Wall Street investment banks, some of them are not that large, could not meet their obligations of buying treasuries. Much more so than for the other smaller banks. As of the second quarter of 2019, the big four banks alone accounted for more than 50% of the total treasury securities held by banks in the U.S. So the four largest banks hold a massive amount of U.S. treasuries. Now, I should probably try to reach out to Victor Sperandio and see what he thinks of all this, because his thesis has been that the hold-to-maturity accounts that these large banks can stuff, they've changed the rules. They got the rules changed at the Fed for their accounting again. And the banks can stuff these treasuries in hold-to-maturity accounts and not write off any losses. So I'd like to get Victor Sperandio's thoughts on what has been happening in the repo market for the last couple months and how that may conflict with what he's been saying about hold-to-maturity accounts. As of the second quarter, the largest 30 banks held about 90% of treasuries. At the same time, the four largest banks held only about 25% of reserves, funding that could supply short-notice repo markets. Cash balances held by the U.S. Treasury in its Federal Reserve account, the Treasury General account, grew in size and became more volatile, especially after 2015. The resulting drain and swings in reserves are likely to have reduced the cash buffers of the big four banks and their willingness to lend into the repo market. After the debt ceiling was suspended in early August 2019, the U.S. Treasury quickly set out to rebuild its dwindling cash balances, draining more than $120 billion of reserves in the 30 days between August 14th and September 17th alone, and half of this amount in the last week of that period. So this is something that the current Dallas Federal Reserve Bank president, the one who took over after Richard Fisher, has talked about. That it's the U.S. federal government issued too many treasuries in too short a time, and that's what's caused problems in repo. And this paragraph just agreed with that. By comparison, while the Federal Reserve runoff removed about 5 times this amount, it did so over almost 2 years. Besides these shifts in the market structure and balance sheet composition, other factors may help to explain why banks did not lend into the repo market despite attractive profit opportunities. Yeah, there was enormous amounts of profit for banks to lend overnight in repo. Could have made a killing. This means that there's enormous counterparty risk. The banks don't trust each other. A reduction in money market activity is a natural byproduct of central bank balance sheet expansion. If it persists for a prolonged period, it may result in hysteresis, effects that hamper market functioning. I think they're talking about animal spirits. So they're trying to talk about emotional rather than, because if banks were making rational decisions, they would say, we're only loaning to this other bank overnight and we can make an extra 7% or more returns. Only for an overnight loan, we should do the loan. And instead, they're in panic mode. Their emotion, they're just worried that, well, what if the counterparty fails? If it persists for a prolonged period, it may result in hysteresis effects that hamper market functioning. For instance, the internal processes and knowledge that banks need to ensure prompt and smooth market operations may start to decay. This could take the form of staff inexperience and fewer market makers, slowing internal processes. Moreover, for regulatory requirements, the liquidity coverage ratio reserves and treasuries are high-quality liquid assets. Gold should be, according to the new Basel III rules, but these banks, European banks and others, do not like buying gold. They like selling it to Swiss refiners, or charging clients for gold or silver in vaults that they don't have. Of equivalent standing, but in practice, especially when managing internal intraday liquidity needs, banks prefer to keep reserves for their superior availability. The reserves can be used as collateral for a bunch of things. Bets, loans, derivatives, trades, a bunch of things. So the people who said that the reserves never left the Fed, that those reserves can be used as collateral for a bunch of things by the banks. I've interviewed Nomi Prinz about this extensively. She was a managing director, I think, at Bear Stearns and Goldman Sachs. And she's talked about this in interviews, not just with me, over the years. You can look it up in the archives or Nomi Prinz interviews. Shifts in repo borrowing and lending by non-bank participants may have also played a role in the repo rate spike. Market commentary suggests that in preceding quarters, leveraged players, e.g. hedge funds, were increasing their demand for treasury repos to fund arbitrage trades between cash bonds and derivatives since 2017. Remember also that the reversal on the 10-year treasury yield was pretty harsh. It went from 1.44, 1.45-ish range, and it went up to 1.7 pretty quick. So maybe that was, if I remember correctly, that was a couple of months, at least 3 or 4 months before the repo spike came out. So maybe that was involved with problems in repo. Maybe that spike in the 10-year treasury yield was what was preceding it, because hedge funds were gambling, leveraging up bets to bet on the yield falling on the 10-year, and then it reversed, and then that started causing more problems in repo. Increasing their demand for treasury repos to fund arbitrage between cash bonds derivatives since 2017. Money market funds have been lending to a broader range of repo counterparties. So money market funds are supposed to be lower risk. They're not supposed to be lending into repo. And this is what the Bank of New York Mellon has been doing. They've massively grown their business, the Bank of New York Mellon, as the private repo market maker. In only 2 or 3 years, it's grown massively from about zero to over $100 billion per day in business, I think. Cash bonds and since 2017, money market repo counterparties, including hedge funds, potentially obtaining higher returns. These transactions are cleared by the Fixed Income Clearing Corporation, with a dealer sponsor, usually a banker broker dealer, taking on the credit risk, resulting. If you want to read the rest, there's some more fine print here, but that's pretty much the gist of it. It's about 4 pages.
There's also summary. If you don't want to read more than the 4 pages, there's summary articles from Reuters, from Olga Kotaga, that came out today from Reuters London, and a Bloomberg article that also came out today from Liz McCormick, summarizing the Bank of International Settlement report. Two super chats. Thank you, Justin. Thank you, Penguin. Do I think Repo Madness is a tailwind for gold? It is a good question. So in the short term, no. I think Federal Reserve balance sheet expansion is a tailwind for gold. I think if the Fed has to continue to cut rates, that would be good for gold. And if the official balance sheet of the Fed continues to expand, and let's say Jim Bianco is right, and let's say these term repos do not all roll off the balance sheet, and let's say a month from now, the Fed's balance sheet is up another 50, 80, 100 billion. Then people are going to start to really get worried. Because the official narrative is that these repos are only overnight, and so all those overnight loans are all no big deal, that doesn't count. And then what people are saying about the term repos is that, oh, it's only 14 days, they roll off, and it doesn't add to the balance sheet, but we've seen otherwise. Because there's only been 2 months of not QE. So that's only 60 billion per month, only in air quotes, considering that that was the size of past QE programs during and after 2008, of some of the past QE programs in per month treasury buying. So that's only 120 billion in balance sheet increases, and that does not explain the Fed's balance sheet up almost 300 billion since the end of August. So no, I don't think Repo Madness is directly beneficial for gold. It matters what the Fed's actually going to tell us on the official balance sheet. Most financial professionals don't care about Fed audits or Austrian School Economics. They care about what the official Fed balance sheet is. They don't care. I've had conversations with a lot of mainstream financial professionals. They don't care that the one-time partial Fed audit that Ron Paul got showed that there's tens of trillions printed. They don't care about this stuff. They only care about Fed's official numbers, what the official inflation data is. Oh, and by the way, Jim Bianco, who is covering this repo extensively, he is not a gold bug, and he is buying gold on dips. And he's been doing so for months now. I've covered this on my channel. And for his paid subscribers, for his macro newsletters, bond newsletter, macro newsletter, he recommends buying gold on dips too. So even though gold price in US dollars is down, there are people still buying it on dips. Yasser asked, does this mean there was one bank failing? We don't know. Probably more than one bank. Everyone knows about Deutsche Bank. They were even discussing Deutsche Bank's crazy amount of derivatives on CNBC's Fast Money trading show, and they normally never talk about topics like that. That was a couple months ago. So you know things are bad when they're publicly talking about that. That was when Steve Eisman was on, the guy from The Big Short, and he's been short Deutsche Bank for a couple years now, so he's made a lot of money on that short, even though it's been volatile. So I think my personal opinion is that it's more than just Deutsche Bank. There's a lot of evidence lately about Japanese banks. There's a lot of other European banks with problems. Chinese banks are a mess. I agree with Brent on quite a bit, except he thinks that gold was going to get, the paper gold price in US dollars was going to get smashed more, way below 1,400, and I disagree with him on that. Because he doesn't cover the mining companies, the supply side, the primary gold miners like I do. The mining companies can't really, they're not raising mass amounts of capital right now. There is mergers and acquisitions being done, but the miners themselves, their operating cash flow has improved the last couple of quarters. Their margins have improved. But when you've had a bear market for 8 years, a couple good quarters doesn't solve all your problems. So I disagree with Brent that the dollar milkshake theory, the dollar either staying at these levels or getting stronger will crash gold. I disagree. If that happens, you're going to see a lot of miners go bankrupt. We have not seen massive amounts of bankruptcies in miners yet. But if gold were to
theoretically, I'm not saying this is going to happen, but if it were to theoretically go back down to 1,200 or lower, then there would be bankruptcies for gold miners. Some gold miners, the management teams would panic. They would sell the assets of the company for pennies on the dollar to hopefully a better gold miner with a better balance sheet. But I think the probability of that's pretty low. Banks with record earnings often need a payday loan to get past tax day. Well, Christopher Whalen is calling it the bank Deadpool, and he's been adding more banks to it. He has blog articles on the institutional risk analyst, I think. I've linked to his articles in the past. I've interviewed him in the past in the archives too. He's one of the better bank analysts out there. Eric asks, is it possible repo morphs into a bigger and significant issue? Yes, if so, larger cracks will appear in credit spreads and broader measures of financial conditions. That may happen soon. So the main problem that I was talking about from 2007 to 2008 with the repo markets was one of the main sources of good collateral was mortgage-backed securities. And mortgage-backed securities went from paying their interest payments, being rated AAA and quote-unquote good collateral, to all of a sudden the collateral was worthless. People were doubting whether the collateral had any value. Woolali, thank you for the $5 super chat. Thank you for the $5 super chat, Dimitri. Dimitri asks, Jeff Gunlock said rates will never go negative in the U.S. What is your opinion? There's a fight. So the academics and the people in the central bank, and obviously now President Trump, who's tweeting about it, want negative interest rates. The problem with negative interest rates, and I was debating doing a show on this because Danielle DiMartino Booth has kind of talked about this a little bit in interviews, is if you go to negative interest rates, they actually break cash flow projections. So they destroy the ability of market participants, businesses, to make sound economic calculations with cash flow projections. So negative interest rates would destroy capital asset pricing model, discounted cash flow projections, and net present value. Because normally when you make those calculations, those cash flow projections with those mainstream academic pricing models and cash flow projections, you normally are discounting the cash flows based on the fact that you could go get a relatively low risk, higher interest rate treasury. So there's already tons of negative yielding debt and negative interest rate policy. And what Danielle DiMartino Booth has said is that negative interest rates in the European Union and Japan already broke the cash flow projection models in Japan and Europe. And those firms are using American models now so they can do the economic calculation. So if everyone goes negative, and Nolan Watson has talked about this too. Nolan Watson is a gold medal CEO of Sandstorm Gold. He's a really good accountant, gold medal winning accountant and CPA. And he said that, in his opinion, regular businesses, if they go negative interest rates in the US and Canada, regular businesses will not be able to make any decent economic calculations for future investments and project cash flows, and that will prevent businesses then from making any smart long-term investments. And if you're not making long-term investments, if you're not making CapEx investments, that means less jobs. That means less new products and services. That means that maintaining property, plant, and equipment, because normally when you run these cash flow projections, you're trying to see if the investment into either upgrading or new property, plant, and equipment is worth the investment, and you're projecting out the cash flows. And that's how you do cost-benefit analysis and risk versus reward as a business for an investment. Because you're saying, for example, with a mine, is when Yamana Gold had a bad balance sheet and they sold their best producing mine, Chapada, which is a copper and gold mine. And Yamana Gold did not have a good balance sheet, and they know that they needed to put like another $200 million of upgrades into the Chapada mine, even though it's already making money now. They knew that they've been delaying the upgrades for a while, and they can maybe delay it another couple years, but they didn't have the $200 million. But you run the calculations and saying, is that $200 million worth it to make the investment? And what return am I going to get on it? How much is it going to increase cash flows? Ibanez buyer, thank you for the super chat. It depends. For newsletters, it depends how much risk you want. Because on the junior side, Brent Cook is good, and his business partner, they are economic geologists, and they actually go visit the potential mine sites. So they're doing a lot more boots on the ground research work than any other junior newsletter writer, as far as I know. And they're not getting paid. They're not sneakily getting like a bunch of warrants, or they're not getting paid $20,000 or $30,000 to write a research report talking about how good that junior is and then not disclosing it to their email subscribers. So Brent Cook, exploration geologist, is pretty good for juniors. For the other mining stocks, it just depends. I'm not a big fan of a lot of the newsletter writers. It's really tough. I'm not a big fan of most of the newsletter writers. I'm friends with some of them, but the track records on some of these guys are just not very good. Probably better, just my opinion, probably better if you just buy some mining stock ETFs. I've said this for a long time, the average retail investor should not own any individual mining stocks. I know newsletter writers that don't do any due diligence and recommend, or almost little due diligence, and recommend mining stocks. And then the mining stock crashes or goes bankrupt, and then they remove it from the portfolio calculations and pretend that they didn't just lose their paid subscribers like lots and lots of money. It's a very common trick in the newsletter writer business. It used to happen where I worked. My boss recommended a Best Buy stock at the wrong time, and within about, I think, a week, this was 2013, I think within about a week it crashed like 40%, and he just removed it from the portfolio calculations and pretended like he never wrote the recommendation. The article was deleted from the website, and I think it was a bunch of... There's a couple really big mining stock ETFs. You have the two Sprott ones. You have Go AU from Frank Holmes, U.S. Global Investors. That has the royalty and streaming companies in there. GOAU. Gold seems like dead money to you. Well, but it won't go to zero. Some of these banks may go to zero. You want to play offense in an environment where the repo market may be up to $500 billion per day. Central banks are doing crazy stuff. Governments are changing the rules, and you want to be aggressive with your investments or trades. A number of governments are talking about banning short selling, so your profitable short trades could be canceled. I personally don't think that this is a time to be very, very aggressive, but that's just me. I'm being pretty defensive here, pretty conservative. Oh, did you see on the screen there, Repo Madness? So CNBC used my Repo Madness months after I came up with it and have done all these podcasts. Of course, no credit to me. So now Bloomberg has used Repo Madness phrase. CNBC has used Repo Madness phrase. CNBC was flashing it on the screen for hours last week. And also Real Vision TV.
Well, okay, Ricky says, based on what you just said, we are dealing with a problem far greater than 2008 crisis. We are. Because back then the repo was 300 billion per month, up to 400 billion per month maximum, according to the charts I've seen in 2008. That the highest repo spikes got to 400 billion per month, and if Jim Bianco is correct, we're going to 500. We're already at 300 billion dollars per day now. So we're already about 30x more repo than 2008. Just depends if the Fed does a permanent repo facility and how large the balance sheet expansions get soon. Trump does not realize negative interest rate policy. He only realizes it for the government spending, the federal government budgets, that's good for negative interest rate policy, and the academics only see that as good for the federal government spending, so the federal government doesn't have to cut any budgets. But if we go negative interest rate policy, it will destroy economic calculation in the private sector. Capital asset pricing model becomes, in my opinion, useless then. And there are a lot of financial professionals, chartered financial analysts, CFOs, people running companies who use that stuff. Which governments are banning shorting? I did a story on this, Dimitri, last week. There was a Reuters article. Carson Block was quoted in it. South Korea was talking about it. Turkey was talking about it. The European Union was talking about it. I think what someone should do, I don't have the time to do this because I have so many things I have to do with research and content. Someone should just buy repomadness.com and just create the numbers. And have a computer program and figure out how Jim Bianco is coming up with the formula and track it. You get a lot of traffic there. It's very similar to the guy who was tracking like all the mortgage-backed securities and all the housing prices crashing prior to 2008. That guy got a lot of traffic. The Reuters article about short banning was extensive. I think it was like 5 or 6 pages. It was a long article for mainstream media. Donna says, as far as the negative interest rates in the U.S., even scarier would be the effect on pension funds and insurance companies that have guaranteed a 6% rate. Actually, some pension funds have guaranteed more than that. Some pension funds need an 8% compounded annual growth rate to pay for all the retirements, all their people's retirements, and they're not getting anywhere close to that. The other problem is that retirees, pension funds, insurance companies have gone further out the risk curve. And that's where collateralized loan obligation CLOs come into the picture because they are offering a higher interest rate until they stop paying. So the pension funds and the insurance companies are big investors in CLOs. Okay, well, that's it for tonight. I will attach links to the articles and the information in the description section if you want to look at this more. So, like I've been saying now for a while, the repo madness, the repo market, it would get worse before things get better. The Fed is throwing near unlimited amounts of emergency liquidity at it. We are to theater of the absurd levels. I'll see if I can get Mark Faber on again. The recording software I use, he did not want to call into the conference call software, and I've had problems with a number of other recording softwares. And he's in Thailand, so it's not... he doesn't do Skype with a lot of interviews. Anyway, I've interviewed people over Skype in the past from Thailand, and it's crashed on me. I used to interview Jim Rogers from Thailand, and those Skype calls routinely crashed. Okay, so thank you to my over 200 Patreon account contributors. Hopefully it'll be 300 in a year or less. My dozen or so monthly PayPal contributors, and people throw me a tip once in a while. It's much appreciated.
I got, let's see how many. 1, 2, 3, 4, 5, 6, 7, 7 or 8 super chats. Looks like 7. I haven't tried Zoom. I've thought about Podbean. We'll see. Mark Faber's definitely still live. He's just been blacklisted from the mainstream media. He's not doing any interviews on the mainstream financial media anymore. They blacklisted him. Okay, everyone have a great week.